The classic ADF strategy of buying an established house at your next posting, moving away 3 years later and turning it into a negatively geared tax write-off against your military salary is officially dead. In this episode, we're breaking down the massive structural shifts from the recent 2026 Australian federal budget. We're looking past the politics to give you the raw truth about what these new tax changes mean and how the changes to negative gearing and capital gains tax will reshape wealth creation strategies for Australian ADF members, veterans, and property investors. The rules of the game have just changed, and a single blind spot right now could cost you tens of thousands of dollars a year in out-of-pocket cash flow. Most people we speak to are saying, well, don't worry, our existing investments and properties are grandfathered, so we don't need to change a thing. But the reality is that while your current assets are protected, your future investment growth will be divided into a complex dual system. If you keep using the old playbook for your next investment, you're walking straight into a cash flow trap. At National Service Financial, we provide specialised military financial advice. We don't just talk the talk. Our founders spent 20 years in uniform, and we've helped thousands of veterans to set themselves up financially for life during and after service. We understand the unique complexities and opportunities that a career in defence provides. So g'day, I'm Steve Owen from National Service Financial. We work with veterans every day in helping them understand their financial situation, helping them navigate the economic and investment landscape, the Australian tax system, and help people build actual predictable wealth. In this episode, we're doing a deep dive into the end of negative gearing for established properties, the brand new 30% minimum floor on capital gains tax, and the exact tactical adjustments you need to make to keep building wealth while serving. So let's get into it, and let's look at the first fundamental restructuring, which is negative gearing for residential property investments. For properties purchased moving forward, the government is completely severing the link between property losses and your personal income tax. You can no longer use a rental property's rental income shortfall to lower the tax burden on your ADF salary and other income. Now here's exactly how the new legislation works. The new rules target established residential properties purchased after budget night, which was May the 12th, 2026. If you buy an established house or apartment after the cutoff, any net rental losses are quarantined. This means that you cannot deduct those losses against your salary. Instead, those losses are carried forward only to offset future residential income or the ultimate capital gain when you sell. Now, there is a new build exemption. Properties that qualify as new builds, which generally add to the housing stock, are completely exempt. Investors in new builds can still access full negative gearing benefits against their personal income. Let's look at a classic scenario that we see with many of our clients. Now, imagine a military member, let's call him Warrant Officer Bob. Bob's 48 years old, he's married with 3 kids, and completely immersed in his busy career. He gets hit with a new posting cycle and moves interstate. Now, historically, Bob would buy an established property at his new base to live in and then turn it into an investment property when he gets posted again after 3 years. Now, with high interest rates, let's just say that property runs at a net rental loss of about $12,000 a year. Under the old system, Bob's salary completely absorbed that loss, turning it into an immediate tax refund at tax time. Under the new rules, because it's an established dwelling bought post-budget night, that $12,000 loss is completely quarantined. Bob gets zero tax relief on his salary and has to carry that negative cash flow entirely out of pocket every single month, while managing a busy household and family life. If you are navigating this new system, here are your tactical next steps. So you need to audit your current portfolio immediately. Confirm that any existing property contracts are properly documented as grandfathered assets so you preserve their tax advantages. Is it time to pivot your selection criteria? If your wealth strategy relies on immediate personal tax deductions, you must shift your focus towards eligible new builds rather than existing houses. You also need to run strict cash flow testing. Never assume a property is viable just because it's real estate. You need to model the actual out-of-pocket holding costs under a quarantined tax environment. Now, a key principle of investing should always be about buying quality assets for capital growth and/or income. The tax benefits should always be secondary, but losing the ability to offset your monthly cash flow losses against your salary could be a massive hit to your budget. It also gets even more critical when you look at the final exit strategy, because of the budget and how it completely rewrote how your eventual profit is taxed at sale. So that takes us on to section 2, which is regarding the CGT overhaul. Now, the second major pillar of this tax reform is the complete replacement of the long-standing 50% capital gains discount. Starting from 1 July 2027, the fixed 50% discount for individuals, trusts, and partnerships is completely gone. This shifts your property and other investment outcome from nominal price growth to real inflation-adjusted returns, while locking in a permanent minimum 30% tax rate. The new framework introduces a entirely different math problem for property sales. What this means is instead of cutting your capital gain in half, your property's original cost base will be adjusted upwards quarterly in line with inflation. You only pay tax on the real gain above that inflation. The budget also introduces a hard 30% minimum tax rate on those real capital gains. This means that no matter what your personal income looks like in the year that you sell, the tax rate on your capital gain cannot drop below 30%. There are a few exceptions. For assets you already own before the 1st of July 2027, but sell after that date, a hybrid model applies. The capital gains accrued up until 1 July 2027 will still get the same old 50% discount, while any future gains you sell beyond that date will use the new indexation and 30% minimum tax rules. Now, investors who purchase newly constructed dwellings are given a unique option at disposal. They can choose whichever method works out better for them, the old 50% discount model or the new indexation and 30% minimum tax model. Now, this directly shatters a very common military strategy. Many ADF members tell us, I'll just sell my investment properties when I discharge or when I take a lower income transition year to minimize the tax. Now, think of the old system like a predictable 50% off coupon. You could use that coupon whenever you decide to cash it in. The new system completely tears that up. If Bob holds a property post 2027 and decides to sell it during a gap year or right after leaving defence, thinking that his low salary will protect him, he'll run straight into that hard 30% tax floor. The ability to time your sale to a low income year to completely wipe out a CGT bill has been effectively eliminated. Now, to adapt to this CGT shakeup, you need to execute these three things. If you hold investment properties now, ensure you have clear valuations leading up to June 2027, so your hybrid calculation is completely optimised. You need to reevaluate your holding structures. Discretionary trusts are facing their own 30% minimum tax constraints under these new budget measures, meaning that individual or alternative ownership structures are worth a fresh look with a financial advisor or an accountant. You also need to calculate the real versus nominal growth. Before buying an asset, model your projections against inflation, because if an area doesn't significantly outperform CPI, the after-tax return profile completely changes. Now, if we look at the third change in the federal budget, it was the death of the family tax trust shield. Now, if you think you can sidestep these property restrictions and capital gains traps by simply purchasing your next asset inside a discretionary family trust to split the income, well, the recent federal budget has closed that loophole as well. Starting from 1 July 2028, the government is introducing a flat 30% minimum tax rate on the taxable income of discretionary trusts. Now, this fundamentally changes the well-tested economic benefits and classic trust income splitting for high-income families. Now, here's exactly how this dramatic policy shift works. Now, historically, family trusts allowed you to stream investment profits or business income to a stay-at-home spouse or adult children in a lower income tax bracket to reduce your family's overall tax bill. Now, from 2028, the trustee will pay a flat 30% tax on that net income before it can be distributed, regardless who receives it. While individual beneficiaries will receive a tax credit for the 30% tax paid by the trustee, those credits are strictly non-refundable. If you distribute trust income to a family member whose personal income tax is below $45,000, they effectively lose the benefit of their tax-free threshold. The excess tax paid by the trustee is simply swallowed by the ATO. The other change is that bucket companies have been blunted. Corporate beneficiaries are completely barred from receiving those credits. You can no longer shuffle trust profits into a bucket company to convert them into refundable franking credits down the line. Now, to soften the blow regarding family trusts, the government is introducing a 3-year rollover relief, effectively a restructure window, starting from 1 July 2027. This gives asset holders a brief, penalty-free opportunity to dismantle their discretionary trusts and move investments into other entities. So let's have a look back at Bob. A few years ago, Bob's accountant told him to set up a discretionary trust, buy his next investment property inside it, and then when he eventually sells it or rents it out, they'll be able to distribute the profits to his university-age kids or his spouse to keep most of the money out of the top tax bracket. Under these new rules, Bob's strategy completely derails. When the trust generates $30,000 in profit and Bob tries to stream it to his son to cover university costs, the trust is forced to fork over 30% in tax up front. His son gets the non-refundable credit, but because his personal wage is below $45,000, that excess credit is completely wasted. Bob gets hit with a severe tax drag, and there's no grandfathering to this, it's just going to happen. Now, if you currently hold assets through a family trust, your immediate action plan requires these 3 steps. You need to audit your current arrangements immediately. You can't afford to wait till 2028. You need to evaluate the ongoing math of your current structure today. You also need to assess the incoming rollover relief benefits. Work with a military specialist financial advisor or accountant to see if transitioning your portfolio into another entity during the window will save you money long term. You also need to map out a multi-year distribution strategy and calculate exactly how the 30% floor impacts your family's net cash flow so you aren't hit with an unexpected tax bill. And this is exactly why looking at these budget updates in isolation is a massive mistake. When you combine restricted negative gearing, index-based CGT, and a hard 30% minimum tax on family trusts, the entire landscape of building wealth while serving has completely flipped. Which brings us to how you actually protect your financial future. The 2026 federal budget has made it completely undeniable. The era of passive, set and forget military wealth creation through standard property investing is officially over. Buying and selling assets can be costly, and you simply cannot afford to get the math wrong. If you want to move away from guesswork and build a clear, structured roadmap tailored specifically to your unique ADF lifestyle, let's chat. At National Service Financial, we don't just understand the tax law, we understand your life, your posting cycles, and your unique goals. Head over to nationalservicefinancial.com.au right now, submit your inquiry, or give us a call. Our client services team will reach out and get you booked in for a specialised strategic meeting with one of our financial advisors. Let's make sure that your time in uniform sets you up for absolute financial certainty down the track. I'm Steve Owen, look after yourself, and I'll catch you in the next one.